Hey there, Mad Money viewers. Today we're diving into the exciting world of short selling. Don't worry, it's not as complicated as it sounds. By the end of this, you'll be a pro at understanding this powerful trading strategy. Short selling is a way to make money when a stock's price is going down. It's the opposite of buying low and selling high. Instead, you're selling high and hoping to buy low. Think of it like renting a car and then returning it later. You're borrowing something, hoping its value drops, so you can buy it back at a lower price and make a profit. So, buckle up and get ready to learn how to short sell like a Wall Street pro. Short selling might seem counterintuitive at first. Why would you sell something you don't own? Well, in the stock market you can. Imagine you believe a company's stock is overvalued. You think its price is going to drop. That's where short selling comes in. You borrow shares of the stock from someone who owns them, usually a brokerage. Then you sell those borrowed shares on the open market at the current price. Your hope? That the stock price will go down as you predicted. If it does, you can buy back the shares at a lower price and return them to the lender, pocketing the difference as your profit. Let's break down the short selling process into simple steps. 1. Borrowing. You borrow shares of the stock you want to short from your broker. They lend you these shares from their inventory or the accounts of other clients. 2. Selling. You immediately sell the borrowed shares on the open market, receiving the current market price in cash. 3. Waiting and hoping. You wait for the stock price to decline. The lower it goes, the bigger your potential profit. 4. Buying to cover. Once the price has fallen, you buy back the same number of shares you borrowed, but now at the lower market price. 5. Returning. You return the shares to your broker, completing the transaction. The difference between the selling price and the buying price, minus any fees, is your profit. Why would investors engage in short selling? There are a few key reasons. Profiting from a declining market. When the overall market is bearish, meaning stock prices are generally falling, short selling allows investors to make money even in a downturn. Hedging. Short selling can act as a hedge against long positions. If you own a stock and are worried about a potential price drop, shorting a related stock can offset potential losses in your portfolio. Speculation. Some investors use short selling to speculate on the decline of a specific company or industry. They believe they have information or analysis suggesting a price drop is imminent. Section 5. Potential rewards, inherent risks. Short selling, like all investment strategies, comes with its own set of rewards and risks. Potential rewards, high profit potential. If you correctly predict a significant price drop, your profits can be substantial. Bear market advantage. Short selling allows you to profit even when the market is declining, providing a hedge against losses in your long positions. Inherent risks, unlimited risk. Theoretically, the price of a stock can rise indefinitely. If the stock you shorted goes up instead of down, your potential losses are unlimited. Margin calls. Short selling requires a margin account, and if the stock price moves against you, you may face a margin call, requiring you to deposit more funds to cover potential losses. Section 6. Illustrative examples of short selling. Let's look at a couple of simplified examples to illustrate short selling. Example 1. You believe company XYZ's stock, currently trading at $100 per share, is overvalued and will decline. You borrow 100 shares of XYZ from your broker and immediately sell them, receiving $10,000. The stock price drops to $75 per share. You buy back the 100 shares for $7,500. You return the shares to your broker. Your profit is $2,500 minus any fees. Example 2. You short sell 100 shares of company ABC at $50 per share, receiving $5,000. The stock price unexpectedly rises to $60 per share. You are forced to buy back the shares at $6,000 to cover your position. You incur a loss of $1,000 plus fees. Section 7. Short selling gone wrong, a cautionary tale. Remember the GameStop short squeeze of 2021? That's a prime example of short selling going wrong, and it's a story worth knowing. Hedge funds believed GameStop stock was overvalued and heavily shorted it. However, retail investors on social media platforms banded together and started buying GameStop stock en masse. This unexpected surge in demand created a short squeeze, rapidly driving up the stock price. As a result, the hedge funds that had shorted the stock faced massive losses and were forced to buy back shares at much higher prices to cover their positions. The GameStop saga highlights the potential risks and volatility associated with short selling, especially when market sentiment and social media frenzy come into play. Section 8. Navigating the shorting landscape. Short selling is a complex strategy that requires careful consideration and a solid understanding of the markets. Here are a few tips for navigating the world of shorting. Thorough research. Before shorting a stock, conduct extensive research on the company, its financials, and industry trends. Risk management. Understand the risks involved and never short sell more than you can afford to lose. Set stop-loss orders to limit potential losses. Market timing. Short selling is most effective in bearish or volatile markets. Timing is crucial, and entering and exiting positions at the right time is essential. Professional advice. Consider consulting with a financial advisor or experienced trader before engaging in short selling. Section 9. Final thoughts, shorting in perspective. Short selling, when executed correctly, can be a powerful tool for sophisticated investors. It allows for profit potential in declining markets and can act as a hedge against losses. However, it's not for the faint of heart. The potential for unlimited losses and the complexity of the strategy make it essential to approach short selling with caution and a thorough understanding of the risks involved. Remember, in the world of investing, knowledge is your greatest asset. So, do your homework, manage your risk, and never stop learning. Please like, share, and subscribe to our channel for more insightful videos on trading and the stock market.